everyone, welcome to this week's edition of Midweek Market Update. I'm Ashley Rosser of Victory Fiduciary, and today what we're going to talk about is just this continuing downward price action that we're seeing across the broad-based markets and kind of what's driving that and what we're thinking for the future. And as an investment committee, what are we looking at? And so I think that we really need to set the stage for kind of where we were before this all started. You will recall that if you've been watching my videos now for the last few months, I've been saying, hey, these returns are great. Markets just keep on marching ahead, but at some point, we're going to have to either have a period of time where we cool off and trade sideways or have some sort of a correction because we can't stay here forever. We are completely deviated, overextended, particularly in the Nasdaq. I said that quite a few times. And so right in February, this is a chart showing generally how much risk were investors willing to take in the market. And so we were even higher than we were back prior to last March, right before the market we had our significant crash correction. So this is where we were back in February. Investors were flying high, really had not a care in the world. They were investing in areas like GameStop and other short squeeze stocks, being very speculative. GameStop today is up another 20%. So some of this has really not changed too much, even though we're kind of in this negative price pressuring situation. Markets, while they're being low, investors are still trying to find areas of just like squeezing every last bit of performance that they can, so they're chasing everything. But this was particularly noted back in February that investors were like, I will take on as much risk as I need to try to squeeze another dollar out of the market. So kind of like an interesting time period that we were in. If you've heard the phrase, you should be greedy when others are fearful and fearful when others are greedy, everyone was being greedy at that time. And so we've seen negative pricing action. We've seen some correction type situations happening. For 1 month numbers, Nasdaq is down just under 6%. So it's particularly, so technology in all of this has really been kind of like at the forefront of taking the brunt, because technology is what everyone really has been writing out since March of 2020 as we kind of came out of the pandemic. That's really what has helped to kind of drag markets along for much of last year, and as a result, they're very extended. We'll talk a little more in a couple minutes about that. So this is the S&P 500, and so what I want to kind of show you here is something interesting, because this is a textbook example of a head and shoulders, and so I just thought it would be neat to be able to show you. So shoulders, shoulders, head right here. And so when we begin to see this formation, markets have to do two things in order to be able to break out of that formation and almost kind of like break the whole cycle here. So number one, they have to be able to hold their line of support, which is right here, which they did. So particularly on Friday markets opened up very high on Friday. They sold off a lot of that, but they were able then to reclaim their 50-day moving average here, which was important. And so the next thing that has to happen now for us to break out of this formation is we're going to have to be able to go on and reach a new high here. And if we're able to do that, we'll break out of this formation, and then really we will be able to kind of say, okay, markets are now in a good position to kind of break out and against new highs and keep moving forward. So that's one of the things that will need to happen for that. But I just thought it was really fascinating. This is like such a perfect example of what happens in this type of formation. And the idea is, our market's going to be trapped here? Are we about to go into a deeper correction, or are we about to kind of shake loose of it? Small caps have been significantly impacted, particularly in the last couple weeks. Small caps have had a tremendous run. I mean, when we talk about how extended small caps were, you can see, so here, these are the moving averages for small caps. We were here at the height right before we went into this last correction. I mean, that is a huge deviation. Now, we're currently sitting at about here. That's still a lot just before to that first line of support there. Now, I'm not saying that small caps are going to drop from here to there. I'm just saying, though, that is still a pretty big disparity between where we are and where we technically should be. Because remember, these areas here, they act like magnets to draw indexes and markets back down to them. So we can only trade so far above or below where after at some point that magnetic quality will kind of drag them back. And so this is where we were. But this up here was certainly not sustainable. And so I kept saying we're going to have some sort of an exogenous event that's going to kind of like break open the streams for this. And so that just happened to be interest rates. Interest rates unexpectedly spiked about 2 weeks ago. And there's a lot of implications there that maybe you hadn't thought of ahead of time. One of the big things with interest rates is the fact that it makes borrowing money more expensive for companies. And so these companies that are already significantly stretched and overvalued, well, we're pricing in the absolute best case, perfect scenario for the next 2 years forward. All of a sudden, if it's going to cost them more money to borrow capital, particularly think small and mid caps, they need to have access to capital even more than large cap stocks might need to. All of a sudden, that starts to kind of break that perfect environment that has to happen for these stocks to continue to advance. So number one, increasing interest rates makes it more expensive for them to borrow capital, which then in turn leads to the potential to decreasing corporate earnings. And again, remember that while the stock market's not the economy, it is completely tied to corporate earnings. And so if rising interest rates are going to affect that, we can absolutely see actions like we saw right here. And I am, speaking of technology, all right, having problems, but we're back. So this is the S&P 500, and again, just to kind of show you here just how deviated we were when we started this process. And again, I don't think necessarily that we're going to have a huge reversion to the mean, but just to show, and this is also showing that our bull market is still intact here. So thankfully, we are still we're trending right along this line here above, but a reversion from here to our lines of support would be at about 27%. And so we should, as investors, should always kind of know though, what is that if we have a mean reverting event, what will that mean? Well, that could mean a 27% decline. And people say, well, that never happens. I mean, we forget that it happened 12 months ago. Actually, I was just talking today, March 9th, this is the day that the Dow Jones closed like 1,600 points down from where it had opened. And this is just when we were beginning to hear about this coronavirus thing. And the NBA decided they were going to shut down. If you remember when that happened, that for me was kind of like the first point that I was like, wow, this could really turn into being disruptive. And that was when I think globally we began to realize that there was going to be serious interruptions in economic production, and markets responded accordingly. So bull market's still intact though for now, which is a good thing. That's what we always want to see. And okay, so here's a visual. So I told you though that the Nasdaq particularly has been under pressure. Nasdaq is comprised mainly of technology-like funds, and so you can see at the height of where we were here, and this is where as of yesterday. So that's our 50-day. So we did actually violate the 50-day moving average on the Nasdaq, and last time that we did that, though not as extreme, was back in October when we were going through our last corrective process. So still have a far way to get to that second line of support there. Now today, I expect that we might not close above the 50-day, but with today's action, we will get pretty close to it, I think, if we don't get above it. So we can trade above and below for periods of time, remember, but I just thought this was a good visual. I mean, Nasdaq has really been under pressure, although today we're beginning to see that rotation where everybody kind of fled to 2 weeks ago, mainly energy and financials. We're now seeing this rotation back to tech. Now, interestingly enough, also, interest rate yields dropped today again. And so that may be giving investors a little bit of additional kind of encouragement that they can go back to some of these areas. And so if you moved to areas like energy and financials yesterday or last week, it's likely that you're going to see some sort of rotation, and we've already kind of seen that today, especially given how oversold the Nasdaq is right now, that we'll likely see that rotation begin to move back in. So you might think, well, then there's like nowhere to be in the market. There's no good place. And so this is why it's important that you use things like relative strength to make determinations about areas of your portfolio, because you can still find areas that will perform well in situations. And so I just thought it was interesting that even though many of the other areas have been under pretty significant pressure, this is our discretionary fund, and it's up 13% year to date, and that includes any negative action that we've seen. And so we have seen, we've seen some dips in the past couple of days, nothing significant though, and so that's ridden this out very well. And so we added those to portfolios kind of like as a recovery play, thinking that when other areas maybe temporarily go out of favor, this would be an area that would likely pick up, and that has paid off really well. Another area, building, construction, industrial fund, that's up also over 13%. So that one got hit actually early on here, but otherwise has done very, very well. And so when these other areas have kind of taken these hits, this has been an area that's kind of allowed us to kind of keep riding that momentum. So you can always find areas. There's always going to be areas of the market that are better to be in or worse to be in. And so the trick is to be able to have a process that shows you where should I be steering towards, where should I be steering away. Now, when you're going through a broad-based correction like what we're doing right now, it's a little harder to find those places to hide. Sometimes you just have to look at the technicals and say this was necessary. Much of what we're seeing right now certainly didn't catch us off guard. It's never fun to go through. I don't like it. Nobody that I know likes when we go through these processes, but intellectually I know it was necessary. So it's kind of like a necessary evil so that we can get to our next goal is that these markets need to reset and kind of resume at a healthier place. So I thought that would just be some things that we could get into today. If you have questions, you can always email me at ashleyer@victoryfiduciary.com. I'm always happy to take your questions, even if you're not a client. I always love to be able to just answer questions you might have or just kind of dialogue back and forth about your current situation. Otherwise, I hope you're staying safe. And if you're in New Jersey, I hope you can get out and enjoy that sunshine. And we'll talk to you next week. Have a great day.